The global economy was just held hostage by an 8 million barrel disruption, and Wall Street is lying to you about the Federal Reserve's next move. Welcome to This Explainer. Today, we're tearing down the fantasy narrative you keep hearing on the financial networks, and we're going to show you the raw data of what is actually happening in the 2026 macroeconomic landscape. We've got a lot of ground to cover, so let's dive right into the data.
8 million. Let that sink in for a second. That is the exact number of barrels of crude oil that have just been violently ripped offline every single day. It's literally the largest supply disruption in history.
And why is this happening? Well, tanker traffic through the absolutely critical Strait of Hormuz corridor has collapsed by a staggering 95%. That is a fifth of the entire global oil trade just completely paralyzed by conflict.
The physical reality on the ground is wild. Over 3,000 merchant vessels are currently physically stranded out there due to the blockade. And with export routes totally cut off and local storage facilities basically overflowing, producers in the Persian Gulf are being forced into massive production cuts.
The immediate result? Brent crude spiked all the way to an intraday high of $138 per barrel. That price transmission was violent, it was instantaneous, and it unleashed absolute chaos across global commodity markets. To prevent a total systemic economic collapse, OECD nations went into historic panic mode. They literally drained global oil inventories by a staggering 129 million barrels in March alone, just to keep the system afloat.
Now here is the inevitable consequence that's hitting your wallet right now. U.S. consumer price inflation has rapidly accelerated back up to 3.8% in April 2026. So that whole disinflation narrative, yeah, it's officially dead.
And you can connect the dots right here. This inflation spike is being driven by a massive 17.9% annual surge in energy costs.
Now, before we dig deeper into what this means, I need to state that this content is for informational and educational purposes only. It is not financial, legal, or tax advice. Investing in macro assets carries significant risk. Consult a certified financial planner before making any portfolio adjustments.
Okay, moving to Section 1. Wall Street's rate illusion and the disconnect between markets and reality. Wall Street is selling a fantasy of a soft landing while the global economy burns.
Now, what's really interesting about this slide from Morgan Stanley is that they are somehow pricing in 50 to 75 basis points in rate cuts, meaning aggressive interest rate drops, and S&P targets of 7,500. They are basing this on a disinflationary boom that simply doesn't exist anymore, just to justify these double-digit market returns.
This brilliantly illustrates the extreme divergence between what equity markets are pricing in and the catastrophic tail risks developing on the ground. Wall Street is literally hoping for a market melt-up and rate cuts while the physical economy suffers a violent energy shock and rebounding 3.8% inflation. Equity markets are acting like it's a flawless soft landing, but physical commodity markets, they're bracing for impact.
Section 2. The Federal Reserve Trap and Institutional Gridlock. The central banks are trapped, and the data proves it. If you want to survive the 2026 stagflation trap, hit subscribe right now before the algorithm hides this reality.
So the crucial point here is that the Fed is completely gridlocked. Back in April, inflation rebounded to 3.8%. By May 22nd, Kevin Warsh was sworn in as the new Fed chair, facing immense political pressure to aggressively cut rates. But in this totally unprecedented twist, Jerome Powell stubbornly refuses to retire. He's actually remaining on the board until a minor Justice Department investigation into headquarters renovation overruns concludes. I mean, you literally can't make this stuff up. With 3.8% inflation and a deeply divided, stubborn rate-setting committee, unilateral rate cuts by Warsh are near impossible.
All right, Section 3. Why central banks buy gold, the smart money pivot. Let's move to the next act and see how this builds into what institutions are actually doing with their money behind the scenes.
I want you to ask yourself this. If Wall Street is telling you everything is perfectly fine, why are global central banks hoarding physical assets at a historic pace? What is this smart money actually doing right now? Just look at these numbers. Goldman Sachs and UBS are tracking historic, price-inelastic official sector purchases of between 720 and 950 tons of gold this year. And by price inelastic, I mean these central banks literally do not care what the price is, they are buying it regardless to hedge against this exact stagflation risk. There are three specific structural demand drivers creating a massive floor under physical assets right now. First, Poland just bumped its gold reserve target to 700 tons. Second, relentless accumulation. China's central bank has been on a 15-month continuous buying streak. And third, global gold ETF holdings hit all-time highs of 4,171 tons in February. This isn't speculative day trading, folks. It's a fundamental flight to safety by the largest pools of capital on the planet.
Section 4. The $6,000 target. Repricing the architecture. We are witnessing a fundamental structural repricing of global assets. Let's look at the actual institutional targets.
The biggest names in finance, JP Morgan, UBS, Wells Fargo, and Bank of America, are all clustering their 2026 gold targets between $6,000 and $6,300 per ounce. Why? Because they fully recognize the severity of the energy shock and persistent sovereign debasement. Wells Fargo actually upgraded their target by 40% in a single revision. The consensus is absolutely clear. Institutions are modeling a world where real assets massively outperform paper money. The secret isn't predicting the Fed. It's front-running the central banks. They are buying physical gold at record paces because they know the dollar is being weaponized. The solution is the hard asset electron barbell strategy. To see the exact ETF allocations we're using to execute this, click the explainer on screen right now, breaking down our Tier 1 portfolio defense. Watch it immediately. The global monetary architecture has changed forever. The institutions are already heading for the exits. The only question left is, will you be holding the paper when the music stops?